also joined by Sameer Dalal this morning. Sameer, excuse me. Sameer, some of the private sector banks, smaller ones, IDFC FIRST, AU Small. There's also Bank of Baroda who's come out with numbers. The numbers at the outset look stronger for some of the smaller banks. So that's where it seems that there is relative strength both in earnings as well as in key metrics that we typically track for banks. And for PSUs, there's headwind. Bob, for example, has guided for an ECL provision of 22 odd bips every year for the next 5 years, which means that that will weigh on profitability. How should one look at the banking tilt? What's your preference?
Yeah, so good morning, Harsh, and thank you for inviting me on the show. So, look, results have been good. So first I want to say what happens in the market and what companies do is something completely different, because even IndusInd Bank reported good numbers and then you saw a stock correction, right? If you look at the IDFC FIRST Bank earnings, you can see the strength in the NIMs coming back. You can see that the NPA provisions that are coming down are benefiting them. The CAPEX is benefiting. The cost optimization is benefiting them, because what's happening is as the loan books are growing, the OPEX cost, which has generally been higher, they're getting the benefit. Similar with AU Small Finance Bank. And you got to remember, all of these companies are raising a lot of deposits on low, giving you higher CASA saving ratios, right? Rates. So over a period of time, once they get to a certain scale and size and they do some further cuts in their CASA rates, you'll get benefits. For me, mid-cap banks is something that you should focus on. I think there is an opportunity there. You have to make a mix between large and small. Now, the second question, you talked about Bank of Baroda. Yes, they've given a slight bit of increase in ECL provisioning rates, but that's okay. If you look at the headline numbers, you'll think, oh, the bank's done really poorly because the 1,000 crore profitability versus 6,000 crores last quarter and 4,000 crores the year before that. The quarter one last year. But there's a one-off provision, which is a one-time effect. You eliminate that one-time effect and you look at the NIMs and you look at the business that they've done actually a damn good job. I think PSU banks are trading at 0.7, 0.8 times respectively, which are very, very attractive, which basically tells you if banks shut down today, if they stop entire operations, I as an investor would get 30% more from liquidating the bank. So for me, this is a great buying opportunity, I think, for in the banking space, the PSUs, the mid caps, even the large caps. Large caps, some of them have become attractive. I just discussed IndusInd before we started. Good results. Management is talking about pivoting to growth in the microfinance space, which is the high yielding NIMs. And the stock sells at 5-6% after a good set of numbers. So what happens in the market right now is very different from what's actually results are coming up, but good results and good. We believe that the banking sector is something that will do really well over the next 2 years, and one should invest and not shy away.
No, surely that one-off in Bob, changing the numbers, but even excluding the one-off, Sameer, what I'm alluding to is last year's profitability of around 6,200 crore and X the one-off, profitability at 5,600 crore, other income falling, NIMs falling, that doesn't bother you?
The NIMs have come off a bit, but okay, we've discussed this also with you before.
Yes.
What determines the NIMs, right? So when in a banking sector, when you are in a rate cut scenario, you have to cut your lending rate right away because you're doing cost plus, right? But your cost doesn't come down right away because you have given 2 years, 3 years FDs or term deposits, which will reprice themselves when they mature because you'll reprice them lower. So in the falling interest rate scenario, which we had over the last, say, 12 months, the banks have had to take a NIM suppress. And that has been seen across the banks. It's not only Bank of Baroda, right? And we believe that now things will start picking up because they will start repricing their borrowings lower. Their deposits lower. And as that happens, the NIMs will expand. And then, of course, we know that the bank's loan book by itself is also growing. And that will help the OPEX again. So from both angles, we think the worst is in the stock and the worst is probably in the price. So things can only look up and better going forward. And that is the point I'm trying to make, that, look, we are focusing on NIMs a little low, but are the NIMs going to be low going forward? They're going to start moving up from here, not going down further. So the worst is priced in.
Sameer, in that case, another big thing which is there is the ECL provisioning, which will come in for many of the public sector banks, and is going to be much more for PSUs than private sector. Is the street factoring in that? Because in the case of BOB, they've indicated around 110 bips impact, which is around 12,000 odd crores.
Look, the ECL provisions have been hiked, yes, I agree. But a lot of the times the ECL provisions does not mean that it will turn into an NPA itself, or it will lead to gross NPAs and net NPAs going up. This is just, it's based on expected credit loss, which may or may not occur. So just to assume that it is going to happen is something I disagree with. Having said that, yes, everyone is going to have to reduce their guidance is a little bit lower, but uh, again, stock is down from the top. 0.7 times book value. Let's assume we take that ECL provisioning and increase it. The ROAs may come down by maybe 7 to 8 pips, right? Okay, that will happen in the short term, but eventually the bank will move their NIMs higher, and that will compensate that. So the impact is going to be very marginal, if you ask me. So from that perspective, I'm not too perturbed by that.
Welcome back to the market. We still have Sameer with us. Sameer, in the FMCG pack, you have had Tata Consumer coming out with decent set of numbers, especially the growth businesses and Indian branded businesses doing very well. What's your view on that?
Yeah, very good results actually. I was quite surprised to see the top line growth that came through. We have not been as constructive, unfortunately, on the FMCG space because we think that growth is going to be tepid. It's going to be because these are very highly penetrated markets already. Now, what you're doing is yes, the market's growing, but you're competing against the players and you're trying to steal market share. And that we always think is going to be a more difficult thing than a business that's growing. So the new businesses, some of them are still early stage, which is why we are seeing the growth, but very, very strong numbers. Where we find difficulty in the FMCG entire space, Nestle also posted excellent numbers, right? Tata Consumer is a decent set right now. Is the valuations. They've all moved up and they've all traded at very high levels for a very long time. So when growth had slowed down over the last couple years, the PEG started looking expensive themselves. So if growth is coming back and this can be sustained over 1 or 2 quarters, then we need to revisit, obviously, whether these high PE multiples and high target estimates can be achieved. But for the time being, we still think we want to see continuity in the growth in sales, the operating leverages playing out in these businesses. But yes, it's something that we have to revisit, but positive numbers and positively surprised on Tata Consumer as well.
Another sector is the power sector, NTPC. Good set of numbers on a consolidated basis, and adding nearly 1.8 gigawatts in capacity. They have nearly 35 gigawatts under construction there. How do you look at NTPC?
So, I've been on your channel quite some time. You must be knowing one of the sectors that I'm most bullish on for the next 2-3 years is the power and the power ancillary and the entire space in that, right? Now, unfortunately or fortunately, NTPC having such a large base that they already have of 90 plus gigawatts of capacity, yes, they're adding, and a lot of that addition is happening in the subsidiary NTPC Green, where they're expanding in a very large way, right? The green energy scope. So my take is it might make more sense to look into NTPC Green. Yes, the valuations there will look ridiculous because they're in the setup phase, and when you're always doing the capex, the profitability is not going to look that great because once your plant starts running and you start generating the revenue from that, then it starts. But for me, NTPC, because of the fact that thermal power is not going to grow at the same pace, so you're relying very highly on your subsidiary for growth. Plus, they work on a fixed ROE kind of a model. It's not going to be a major re-rating story, right? NTPC, unfortunately, versus I think NTPC Green and subsidiary, I think there could be a re-rating that could happen over a period of time once more of the capacity comes on stream. Once you start seeing the profitability moving, starting to jump, not moving up, but jump significantly. And that is where I would be more interested. But good set of numbers from NTPC. But like I said, I'm not very positive on NTPC.
Sameer, if you look at NTPC, 90 gigawatts is the kind of combined capacity that they have between NTPC and NTPC Green there. When power companies reach that kind of scale, do you think that the synergies of the scale now come into play and there is, a bump up to the margins also that comes in?
Um, so look, the benefits that are going to come, again, I'm specifying, is from NTPC Green, because if you look at where NTPC as a business model for the thermal power, they're allowed X amount of profitability based on the kind of capex that they're doing. And there are certain plants where they're able to allow them to make a slightly higher profitability, because eventually these were government companies with certain return fixed and things like that, right? Where they were given coal at a particular rate or coal mines at a particular rate because of being a providing power. So am I expecting, just because the scale has come in, some operating leverage? Yes, but what is the total OPEX, which is, so if you have to break up the gross profitability versus the OPEX cost, I mean the OPEX at the central offices now is not that large. And given the fact that it's not that large, I don't think that's going to be a game changer in the profitability. Where I think there's going to be a game changer in the profitability. So, you all just did a flash on NTPC Green trading at about 140 times earnings on your screen right now. I just saw it. But now extrapolate that once all the capacity 2 years down the line comes on stream, right? Uh, and that is going to suddenly see jump in profitability, because bulk of the uh, uh, capex that will come through will lead to straight cash flows. Second, this is a very high cash generating business. Why? Because depreciation will be very high. So the cash flows will start increasing. So from the cash angle of the business, also NTPC Green for me is a very attractive play. So that is why I said focus on NTPC Green. And when you're looking at NTPC as an overall entity, they have NTPC Green as well as a subsidiary. So that benefit you'll get, but you'll never get the same leverage that NTPC Green by itself will get.
Point taken, Sameer. Some of the other pockets, Sameer, the IT pocket, how are you playing that one?
So, we've actually started buying into some of the IT stocks. We think the worst is in the price. We've been saying for a while that, yes, IT growth has been a concern. And we still think growth is going to be a bit of a concern. But I have been of the opinion that once the AI integration angle starts coming through, Indian IT will stand to benefit. Secondly, Indian IT is also going to start using AI for its own operations, which means that they could probably start lowering the cost of doing some of the activities that they're doing, and start making higher margins. Now, all of this is going to take time. I'm not saying IT stocks are going to run up right away, or they're going to see anything great over the next 2 years. But I'm looking at it from a different view, where I say from the next 6 months to a year, if I can generate, say, 6 to 8% div yield and maybe 3 to 4% stock appreciation, I get 10, 12%. But once year and a half down the line, the implementation, and you see the growth numbers coming back, the valuations have become so, I don't say attractive, but so reasonable that from here the downside looks a little limited. People keep comparing that, yes, US IT is trading at a lower price, so Indian IT can correct further. Look, all of that can happen. I'm not smart enough to know where the exact bottom for all of these stocks are. But if I were to take a call, I think we are closer to the bottom than we've ever been in IT. And when the recovery happens, it will be quite strong. So you slowly accumulate over the next year. I'm not saying buy everything today, but over the next year and a half, maybe 7% or 10% of what you want to deploy for the IT sector. You start doing it on a monthly basis. And if you see the turnaround happening a lot faster, you then take a call based on that. And I think what you're seeing is, look, Infosys numbers that came out, everyone talked that there was a drop in profitability. They've reduced the guidance. Yes, they've reduced the guidance a little bit on the top line. But if you look at it, the operating margins have been the highest at 21.1. we believe that this trajectory of operating margins will continue a little bit further. We've been saying that for a while that IT margins will increase. And then you have the the rupee depreciation that's happening, which is also going to benefit them, make them more competitive. Uh, Plus the integration of AI, which Infosys is doing already 8% of total revenues coming from AI. And as that scales up and is growing at a faster pace, you'll see the profitability per employee also going up. So all of those are benefits, and the worst could probably be in the price. So slowly accumulate.
Great. Sameer, great to have you on the show today. Thanks as always for joining in.
Thank you.